I didn't expect the government to have to step in this year to implement a cooling measure, but they did. Now let's get right down into it. We're gonna start off first with, I'm gonna wrap the first two predictions together. The slowdown in volumes as well as the slowdown in price index increments. And now let's see the data behind it. The end result was that this was pretty accurate. So first things first, let's take a look at the volumes, okay? So I got this table from the MAS Financial Stability Review 2023, or just published in the later part of November. A very, very good read for those of you who are interested. But for those of you who don't like reading such stuff, I'm going to run through the TLDR of which later on in the video. So as you can see, the transaction volumes have moderated to pre-COVID levels, as you can see over here, quite similar to where we are in 2019. And the reason behind the slowdown in volumes from the eyes of an insider, somebody who is in and around the market on a regular basis, is the fact that number one, the euphoria, the FOMO of the post-COVID period has sort of died down, primarily also because of interest rates. But other than interest rates, which is the obvious difference between the period in 2020-2021 versus now, it's also the fact that prices have came up quite a fair bit during the 2020-2021 period. And as prices have climbed, interest rates coming up has created sort of a pullback in terms of loan affordability, because the banks utilize a high interest rate, higher than MAS stipulated interest rates, right? So for the benefit of those of you who don't know what I'm talking about, so MAS stipulates a 4% interest rates for the stress test in your TDSR calculation, telling you how much loan you can take. With SORA spiking, interest rates spiking, the banks have actually utilized 4.7 to 4.8% to calculate your TDSR, how much loan you can take. Now, so this with an increase in prices followed by a drop in loan that you can take, right? Of course, unless your income has come up. If not, with higher stress test interest rates means your loan comes down. So now there's now a gap between what the seller is asking for versus what buyers are, number one, willing to pay, number two, can afford to pay because of the stress test interest rates, which later on in the video I'm going to talk about the likely impact of all of this with the upcoming or the commonly accepted consensus that interest rates are going to taper off, if not come down slightly in the later part of 2024. So now this explains, and which is why it was pretty obvious to me that this is going to happen. The very first predictions I've done, basically it's the gap that exists in the market right now, a seller having to ask for a high price, also because the seller likely has to buy something. For that seller, if his loan is already quite low, then he has to make up for it in terms of the asking prices. And as we say, interest rates is the oil, the grease in the gears of the real estate market. And when interest rates are elevated, the gears slow down, the volumes slow down. And with volumes down, quite naturally, the rate of increase of prices would then slow down. And to be fair, the government couldn't afford for the rate of increase to be consistently at that rate, which is why they've came up with cooling measures after cooling measures. I didn't expect, to be fair, I didn't expect the government to have to step in this year to implement a cooling measure, but they did, primarily to penalize the foreign buyers, because they noticed that they are coming in and setting benchmark prices in the CCR. And as one of my previous videos I did mention, because there's also going to be a lot of new launches coming in D1, District 1, your CBD area, and those launches will start to fetch 4,000 PSF thereabouts. If you go to the penthouse, maybe 4,005 Sea View. And so the government want to preemptively hold back all those benchmark prices from happening until they sort of figure out this supply-demand dynamics a little better, and it hit the spot exactly because we expected launches like new port to come up, Marina Bay the launch to come up, but all those were postponed right after the implementation of the new cooling measures that bumped up foreigners' ABSD rates. Okay, so now the rate of increase has slowed down to somewhat similar to the pre-COVID period, okay? Similar to the transaction volumes, also slowed down to the pre-COVID period. Some of you may think that, wow, things are slowing down, but to me, the data also suggests that things are just reverting back to normal. The hype is over, things are back to normal. Do I expect them to come down? I really don't think so, considering the supply dynamics to the market, which I will talk about slightly later on in the video.
Hello, sorry to interrupt. We'd like to take the opportunity to thank you for watching the video and also to share why we do what we do. Is to empower consumers with hard facts and figures, quality research and real-life examples to allow them to make the most informed property decisions. So if you found our videos useful, the only thing we ask for is for you to smash that like and subscribe button so that the YouTube algorithm can push out our videos to more consumers. Thank you, and back to the video.
So this chart may not be so familiar to most of you because most of you would probably be more familiar with this chart, which is the private property price index chart. What they have done is to break down the price indices based on the region. Okay, we have the OCR that is still coming up, the RCR that is also coming up, and if you compare the rate of increase, RCR's rate of increase is actually steeper than that of the OCR. The reason why I primarily put it down to the fact that there's a lot more TOPs in the RCR, and when developments TOP and when they go into the sub-sale market, they tend to fetch a higher PSF as opposed to their resale peers. So with the OCR also have quite a fair bit of TOP, but RCR's TOP developments are fetching quite a fair bit higher price than that of their OCR counterparts, which explains the sharper rate of increase for the prices over here. Now, for the OCR, it's actually seen a dip in the property price index. Now, number one, the immediate thing that you may put this down to is, of course, the ABSD increment from 30 to 60% for foreigners. But actually, if you look at the percentage of foreigners that take up buy properties in Singapore, that figure is not overly big. Okay, it stands in the single digits. I believe it's at from 6% down to 3%. All of that data stipulated in the Financial Stability Review. So you can go in and see. Now, what explains this drop? Of course, you can attribute it a little bit to the withdrawal of foreigner demand from the market, but that's being only single digit. I don't think that's a significant factor. I put that factor down to the fact that there's not that many CCR TOPs in the market. Okay, and so they have primarily been trudging along with all the resale PSFs. So now, but the interesting thing is this year, moving forward, we expect to see a lot more CCR TOPs, right? Such as our Leiden Green, we have Wilshire Residences, you have, I believe, here in Holland sometime next year as well. So the new batch of supply into the CCR is going to hit its TOP really soon, and that's an interesting data point that I would very much be monitoring because they are one of the first few supplies into the CCR with the newer kind of builds, right? So you have your 700 square feet 2-bedders, and then you have your 900 square feet 1000 square feet 3-bedders, as opposed to the supply of old that tends to be a lot bigger, which is why for those, their PSFs sometimes hover up and down because a lot of all these CCR developments tend to be quite boutique as well, so they see huge fluctuations in their PSFs. Okay, and so all of this kind of explains the dip I see over here. Is it cause for concern? I would say it kind of depends. Okay, again, another explanation here is that the CCR is quite different from your OCR and RCR. And how do I explain it is this. What you get in the OCR, be it north, south, north, right, northern part, eastern part, western part, somewhat the same lah. Okay, of course, depending on where you want to stay or where you grow, people have preferences here and there. But you go into the OCR, it's primarily the same thing. Then you go into the outskirts RCR, also primarily the same thing. Or Queenstown, the makeup is quite similar to, say, your Bishan, mature estates, expensive HDBs, some condos. You move down into your Eunos, Marine Parade area, mature estates. Right, some old wealth over there. But in the CCR, it's a very different creature. The CCR is, while not that big, is made up of a lot of different parts, okay? We have our more blue chip CCR stuff, like your Balmoral area, your Chancery area, basically the areas that have your popular schools. And then you have the areas that are very speculative in nature, a lot of foreign demand, okay? Another blue chip CCI area is your Ardmore area lah, okay? Then we have the somewhat other areas of the CCR, you know, you have your Sentosa Cove, and then you have your CBD, your District 1, District 2, so for those of you who watch the oversupply video, for those of you who didn't, I'm going to put that link in the description and also somewhere here. So the District 1, District 2, which also all of these are wrapped up in the CCR, and some of them traditionally don't do well, right? The explanation of which is those areas don't have the organic demand. So again, right, while you look at all this, the general data point for the CCR, do also note that the CCR is broken down into a lot more minute parts, right? A lot of nuances into investing and buying into the CCR, okay? So now moving on to the next one.